right, people, Saturday time, you know what that means. It's time for another video, and today we are going to talk about how you are taxed in retirement. So this one comes up a lot. I think whenever I talk about traditional versus Roth, the natural question is, wait a second, how do they determine how much I'm taxed in retirement? And as a little background there, when I first learned about all this, my assumption was that your tax rate in retirement was determined, and it doesn't make sense, but I actually think this is a pretty common misconception based on what people tell me, was that you're going to be taxed on how much your last salary is. So me as a bright-eyed 21-year-old was like, well, I only make $50,000 now, but when I'm 60 and retired, I'm gonna be the CEO of Google and I'll definitely be making millions by then. So I'm for sure gonna have a higher tax rate, right? And wrong. That is not how your tax rate is determined. It's determined by, and we'll just get this out of the way, it's determined by how much you are spending in retirement. And that might sound kind of like a misnomer, but hear me out. So today, let's set the stage with that little thing we talked about before called the 4% rule. So the 4% rule, if you recall, is what happens when you save your big ass egg, also known as BEG. So this is your net worth of investments. That's a key distinction point I think I should make, is that this is investments. This is not just like a pile of cash under your mattress. And we'll get into the specifics of those investments in a moment based on the study. But this big ass egg represents the amount 25 times your annual spending, okay? So really what the 4% rule says is that once you have invested an amount that is equal to or above 25 times what you spend in 1 year, what you need for a year to support your lifestyle, that is when you can begin to withdraw this little chunk, this 4% chunk, every year, and this egg will never get smaller. It will always replenish itself thanks to compound interest, because remember, it's invested. You own assets, and those assets will continue to grow despite the fact that you are pulling 4% or less. Oh, that's not an order one. I was a public relations major, okay? Less than 4% or less every year. Okay, so that assumes, I think it's like a 6%, 6 or 7% rate of return. But anyway, so a lot of people, when I first talked about this, were like, where did this come from? Like, why is that the number? Well, it actually came from something called the Trinity study, which was done in, I think, like 98, the late 90s. And a bunch of smart people got together at Trinity University, and they wanted to know if this, what amount would an investor have to have in order to retire and use that, a little piece of it every year, and for it to always replenish itself. And so not only did they figure out the math for us, but they also took this idea, this concept, and they pressure tested it by sending it through, I think 100 or more scenarios, possible scenarios. So they said, in the last 100 years, depending on when you retired, would this have held up? With all the stock market dips, and there's this thing called a sequence of returns risk. And so it's probably not surprising to you that if you take out your 4% in a year for the first time you retire when the stock market is down, and then you take out your next 4% the next year when it's still down, that if you really mess with that big principal balance really early on, it can kind of take your trajectory from like this to like this. And so over time, it can become pretty damaging because, again, those early changes compound. And so the 4% rule, though, worked in, I think, 96% of scenarios that they ran. It only failed in a handful of scenarios where somebody would have retired think in the beginning of the Great Depression, and then again like in the midst of a big crash in the 80s where it failed. So one easy way though that they say you can get around that, super simple, you just withdraw 3%. And I love J.L. Collins in his book, Simple Path to Wealth. He says, this is about as sure of a thing in life as death and taxes. Like, you can't say it's guaranteed, but it's basically like, if something happens to where this doesn't work, we have bigger problems, okay? So this is the basis, okay, for when we say retirement, what we're talking about. This is also known as, where's my eraser? This is also known as FI. And so that was kind of what video 1 was about, right? This is financial independence. The moment at which you no longer need an earned income, you no longer have to work for a paycheck because your big ass egg produces enough money every year that you can just straight up live on it. So with that in mind, we are going to move forward. You can hit this at any age, right? It doesn't matter if you are 30 years old, 40 years old, 50 years old. Most people don't reach this point until their late 60s. Some never reach it because they're simply just not saving aggressively enough. If you spend 90% of your income and you only save 10%, it's going to take 40 to 50 years to reach the point that you have saved enough that you can support your lifestyle. So I think there is no age limit or like restriction minimum for this to apply to you, because it's truly just math. It's just math, right? So from here, I think what we have to talk about is who is this, what I'm about to say, what I'm about to tell you about with tax planning for early retirement specifically. Who is this for? I think what's more appropriate is to say who it's not for. If you spend every dollar that you make, if you are on the consumerist hamster wheel and you feel like you are just on that hedonic treadmill, you're making the minimum payments, you're trying to keep up, you can't save money, this might be a very difficult thing to achieve. So I would not start with shooting for this. I would maybe start with the basics first. Get the building blocks, get the foundation. However, somebody that can get to the point, and this may still be you still may get to this point, but somebody that can get to the point where they have got their expenses low and you don't fear that as you age, you are suddenly going to become more, exceedingly materialistic and you're going to need to spend hundreds of thousands of dollars a year to be happy. We all know how that goes. This might just be for you. So let's pretend we have our big ass egg, okay? So I'm gonna give you an example for a married couple. My eggs are getting increasingly less and less egg-like. I'm gonna give you an example of a married couple, because I think most of you, by the time that you are attempting to do this, you're probably gonna be married. So it is most likely more applicable for the majority to hear the married filing jointly tax situation. Let's say you get your big ass egg to $2 million. The reason that I'm choosing $2 million, you will see later, but I chose that number on purpose because 4% of $2 million is $80,000. And so keep with me here. 80,000 is really the maximum amount in the year 2020. Honestly, it's probably higher by now. But in the year for the 2020 tax season, if you had $2 million today and you were going to do this, $80 million is the maximum amount that you could be using from this portfolio completely tax-free. And when we talk about the portfolio, the one thing that's probably pretty confusing or a question that I had was but I'm not just investing into one account, I have my 401k, I have my IRA, I have taxable accounts, I've got multiple brokerage accounts, how do I use them? Like, what does that look like? Specifically, something like a 401k. Because let's say that's the scenario that we've got. If I'm this age, how am I supposed to use that 401k income, right? Well, the magic happens by utilizing our standard deduction. When you are married, your standard deduction, I'm pretty sure this year it's $24,800 or something very close to that number. This is the number that the IRS will allow you to wipe clean off your taxable income every year as a married couple, your joint, income. They won't even tax you on this amount. So this is kind of the amount of wiggle room that you've got, okay? So you're probably looking at this number and you're like, that's quite a bit smaller than that number. How am I supposed to get the rest out? Let's put a pin on that. I just want you to know that for what we're about to do. In order to answer that question, I think it's important to talk about how your money is taxed. And your money is taxed differently if it's earned income versus investment income. So when we talk about earned income, we're talking your paycheck, right? We're also talking about conversions. So when you put money in to your 401k pre-tax, you got to get it out somehow, right? And the idea is that you pay taxes on it when it comes out. So it goes in pre-tax to come out. That's what's called a conversion. When you convert your pre-tax money to post-tax money that you can actually use, okay? So that's the earned income side of the equation. I'm going to do a quick time check because this sucker wants to cut me off. Oh, okay, I'm going to try to we'll probably do a part 2. I'm at 12 minutes. Okay, thank you for still being here. Investment income, on the other hand, is really only taxed 2 ways. Short-term capital gains. This is if you sell an investment after having it for less than a year. Look, nailed it. For less than a year. I guess I didn't nail it because I underlined it and that makes it wrong. And then long-term capital gains, which is what happens when you have your investment for greater than a year. Well, you're a long-term investor, right? And so you're going to have this big ass egg growing for a long time. You're not making a quick buck and then dumping it. So when you talk about your earned income, this is probably the tax rates that you're used to, right? So majority of us are probably making somewhere between 40K and 80K, which puts us in the 22% bracket. Anything above that, you're in the 24, and then somewhere above that, you get into, I think, the 32. And so you can see you're taxed, even if you're making $80,000, you're taxed at the 22% bracket. So you're probably looking at $80,000 in retirement income being like, how would that even work? It's because this category, long-term capital gains, are taxed way more forgivingly. I apologize too, this is the single person. This is like one income. I didn't do the married example here, but I apologize. Anyway, when you are talking long-term capital gains, you are taxed in one of 3 brackets. 0, 15, I believe 20. Yeah. It's also progressive marginal the way this is. So it's not like if you get over the 15% amount that you're taxed at 20% on the entire amount. However, the 0% tax applies for a married couple up to $80,000 of long-term capital gains, which means you can realize 80 grand in investment income and pay nothing on it, okay? 15% gets you up to, I think, 440,000 or some number similar to that. But basically, you'd have to be withdrawing like over $400,000 a year to be paying even 15% taxes on it. So right away, we see it is more advantageous, just in general, to be living on investment income because the tax rates are far more forgiving. let's do part 2. Next, in that kind of unforgiving rate. So we're gonna erase this bad boy. So what happens now? Remember our standard deduction, our $24,800. And again, this is this year. This number goes up every year with inflation. So really, it's $80,000 now. I don't know what the literal number will be in the future, but it'd be equivalent to having $80,000 now, or theoretically should be. We know that this number is what the government will give us every year as a break on our earned income. They'll say, you know what, we won't tax you on the first $24,800. After that, you're on your own. So if we know that our 401k has, let's just make this up. Let's say our 401k accounts for $1 million of our portfolio. And let's pretend our taxable investing account, we're just going to forget about the IRA for now. Let's say that our taxable investing account makes up another $750,000 of it. Remember, because we've got 2 million total. That's our total married couple at 35 balance. So we got to get the money out of this somehow because it's pre-tax. This is good to go. This is going to be taxed as your long-term capital gains. So that's fine. In order to get this money out, we have to do what's called a Roth conversion before we can use it. Remember, Roth means post-tax. So this is standard. Anyone in retirement, whether they're young, old, whatever, is gonna have to do that process to get the money out of the pre-tax account. It's just a given, right? But if you're 35, you need a super special way to get it out because you don't have, you're not 59 and a half yet. So what you'll do is you, as your married couple with no earned income, right? Because you've quit your jobs, you no longer have an income, so to speak. So your earned income to the government is 0. You're gonna transfer, or convert rather, a $24,800 chunk of your pre-tax traditional 401k to a Roth IRA. Technically what happens is you turn it into a traditional IRA and then you convert it into a Roth IRA. So there is kind of a step that I'm skipping there. This is called a Roth IRA conversion ladder is the idea. In early retirement, I have a post on it, but in any case, what happens then though, from a tax perspective, is that the government looks at you and says, okay, no earned income, great. We're gonna tax your Roth, your 401k to Roth IRA conversion, but you only converted 24,800. Okay, cool, so you're good. There's your standard deduction, your tax rate is 0. So theoretically, your money went into that account tax-free, grew tax-free, and then you took it out tax-free. Now, if you're like, but where's the other money coming from? You told me that I was gonna get 80K tax-free. From right here, my friends. Remember, long-term capital gains tax rates, 0% is what you pay on amounts up to, when you're married, $80,000. So, in regular life, when you're working, really what this means is that it's determined by your total income. So if I make $80,000 and I convert $80,000, or that's even the wrong word, forget I said convert, but use another $80,000, realize capital gains of $80,000 by selling my shares and collecting the money, then really my total income in that example is $160,000. So I'm no longer in that 0% rate because my earned income alone is 80K, right? It's really not that special. It's nice because you're only paying 15%. The next bracket up is so low, but it's not like you're getting it tax-free because you have earned income. And remember, your earned income is taxed pretty, relatively speaking, not relatively speaking to other countries, but relatively speaking when you compare it to capital gains taxes, it is. But in retirement, remember, you don't have any other income. In fact, your only income this year of your hypothetical retirement is your $24,800 chunk that you converted out of your 401k tax-free. So what that leaves you with is 80,000 minus 24,800. I should have looked this up ahead of time. So that's 200. Whatever the answer is, can I look this up? I told you I'm not good at fast math. Okay, that would be 55 minus, carry the 1, 56, 2, is that right? 55, 2? Would that be right? Yeah, because that gets you to 56. Yeah, okay, cool, mental math, love it. So you would use $55,200 that you would withdraw from this account that has $750 in it, right? And then you'd be converting your chunk, and you're still under $80,000 of total income, give or take like a couple bucks, you know, depending on when and how you do this and how precisely you do it. But that should give you a total effective tax rate in retirement at 0% or $0. So the other things I think worth mentioning here before we close out is that when I talk to you about that conversion ladder process, remember, because we're 35 at this point, we're not 59 and a half. The trick is that in order to get the money out of the 401k, remember that process where you're in the 401k, you convert it to a traditional IRA, and then you convert that to a Roth IRA, that money will be available to you in 5 years. That's kind of the loophole, okay? So if you perform that in your 35th year of life, when you're retired, you have no earned income, that 24/8 will be available to you when you're 40. So what you'll do is you'll convert using your standard deduction every year for the first 5 years, and in year 6, you get your first one, and in year 7, you get your second one, and in year 8, so on and so forth. So you just do that kind of indefinitely, utilizing that standard deduction, and in the first 5 years, you really have to rely on living on your taxable investments. So that's why it's important that, yes, you are shoving as much money as possible into the 401k, but that you've got enough in the taxable account that it can get you straight through the first 5 years, and then supplement the 24/8 in the remaining years. And then once that account is gone, hopefully by then, really it's just got to get you to 59 and a half. Because once you're at 59 and a half, now all bets are off. Now you've got full access to those retirement accounts, and you can get taxed on them as you use the money or not. Theoretically, you could just set this up in such a way that you are never paying taxes again, as long as you can keep your marital expenses under $80,000. And I would say that's probably a separate discussion, whether you think that that's feasible or realistic for the type of lifestyle that you want to live. I think for me personally, and for my future spouse, we have already decided that we can happily live on $80,000 a year, especially if it means that if we're working or volunteering or doing whatever we want, that would probably outweigh the incremental couple tens of thousands of dollars that we could be spending on admittedly probably extras at that point. So yeah, that's that. The other thing worth mentioning is with regards to that Trinity study. So remember, the Trinity study is what found that 4% was the safe withdrawal rate if you save 25 times your annual spend. So the caveat that I think is worth mentioning, or rather like the footnote here, is that this only works, and when I say works, I mean in the theoretical, like academic sense. This only was proven when you were invested 75%, these were the parameters of the study, if you will. That was like how they set up the portfolio that they did the study with. 75% total stock market index fund, and a 25%, so 75% of the portfolio has to be total stock market index fund, and then 25% of the portfolio has to be total bond market index fund. So you've probably heard me say that I'm in like 90 or 95% stocks. That's because I'm trying to be more aggressive. They're saying that like once you switch to early retirement and you no longer have income and you're really trying to maintain and preserve and still grow the wealth that you have, that this is the mix that they were able to prove worked for this. So that doesn't mean this is the mix that you want to shoot for right now today as a 25-year-old, but just that this was what was proven out to sustain somebody indefinitely through their, whatever. Now, the other thing that's worth mentioning is that both of these have to be low cost. So think very low expense ratios, no additional fees. So if you've got a fund manager that you're paying 1% per year, this doesn't work anymore. Why does it not work anymore? Because you have to withdraw 4% to live on. So that means your option is you can take 3 and they can take 1. Your fund manager can have 1, but it's up to you whether you think you need an active manager to set up this portfolio for you and if it's worth giving them 25% of your income every year. I think that's mostly everything. What do you think? So I guess I'll end it here. The reason too that you have to have these low cost index funds is when I say have to, I mean in order for this study to be academically sound. If you were to just own your entire portfolio invested in like one stock, who the frick knows what's going to happen there? Granted, none of us know what the stock market's going to do over the long term, but we have a pretty confident basis in historical averages that they were able to prove, this held up over 100 years of history or whatever. So if you are curious about more of these topics, I have already written blog posts about this stuff. So if you go on my site and you use the search bar on the homepage, how to use your traditional 401k in early retirement with no 10% penalty. That'll walk you through the Roth IRA conversion ladder that we talked about. And then there's another really good one called What Actually Happens When You Retire Early. And so I basically projected out myself just as a single person, how long it'll take me to get there based on what I'm doing now, and then my actual drawdown strategies of when I would use which accounts to minimize taxes and increase the amount of my money that I can actually keep and use every year. So yeah, this has been part 2 of lesson number 3, and you're probably really tired of my voice, but hopefully you learned something today.